Is India in an exuberance cycle?
I would say that the market is exuberant, but I think it's the nature of the market to be exuberant. It runs ahead, it runs on optimism, it runs on hopes and dreams. It's also become so easy to invest.
Does the market reflect two Indias?
So the market is a strange animal.
A very good morning once again, and welcome to this Fireside Chat on a very relevant topic in current times, especially when we have recently touched the all-time highs, and most recently we have seen a correction from the 26,000 levels. So what more appropriate can be the topic? Do Indian stock markets mirror India's economic reality, or is it just an exuberance? That is the conversation we are going to hold. So today we have someone who talks or who sees fundamentals which explains what it is. A simple and a fun question to start with would be, describe Indian markets in one word for our students. Is it buzzy, resilient, roller coaster, or underrated? Before I pick up more seriously.
I would say resilient. I mean, it's not the most interesting description, but the market right now, especially post-pandemic, it's been very resilient.
Resilient.
Yes.
Okay. That's fine. So it is resilient, so nothing much to worry.
Well, I mean, as of now, there hasn't been. Actually, if you don't mind, there is a little data point I wanted to share with you. This was a story that I had done when I was at the print, and it just shows you how resilient the Indian market is. So there's this, basically I compared the current bull run to the one that happened 2003 to 2008, because it's only fair to compare bull run to bull run and see what happens. So there in the 2003 to 2008 period, the corrections were much steeper and the recovery took a lot longer. Like say for example, in 2004, when the election results came out that the UPA was going to come to power, the markets over the next month fell 13%. And took 129 days to recover. And then like that it happened, there was the Chinese slowdown and currency devaluation in 2006. The market fell 27% and took 137 days to recover. Similarly, the global market in 2007 fell 11%, took 54 days. The COVID pandemic, a month after the news broke out, the market fell 25%. And it took 223 days to reach the pre-crash levels. But now what happened post-pandemic? The market, Russia invaded Ukraine, the market fell just 5% and was back to its previous level in 21 days. That's it. Then the general election results of 2024, there was a lot of volatility in the lead up to that. Market fell 6%, recovered in just 3 days. And in August 2024, there was a global sell-off. The Japanese central bank had raised interest rates unexpectedly, and this created panic in a lot of markets. The Indian markets fell just 3% and recovered in 17 days. So what you're seeing is that post-pandemic, there's been this resilience that the Indian markets have shown, which has not been there all that much earlier, and is something that makes it stand out compared to other global markets as well.
So that's a very wonderful information based on facts. So previously it took a lot of time for the time-wise correction and price-wise correction.
Correct. So, it used to fall more and take longer to recover.
And now gradually it is lessening in terms of the price-wise correction as well as the time-wise correction.
Correct.
That establishes that India markets at least are more resilient.
Correct.
Okay. Thank you. So now, coming to India's GDP and the growth, which has been steady. Corporate profits are at record highs. Inflation currently is moderate. Yet the market's valuations are lifetime highs.
Right.
So are the markets finally reflecting India's long-term growth fundamentals, like for forward PEs, or running ahead of the reality? That's one question that hits every time we reach to such stages.
So I would say, I mean, in general about the economy, Unusually, I'm a little bit of a pessimist. I know that there's a lot of talk about, India being the fourth largest economy in the world, fastest growing economy in the world, things like this. But my take on this situation is that this should be our absolute minimum level of operating. If with 1.4 billion people, we are not growing faster than everybody else in the world, that would mean that we're failing somewhere. That should be our minimum standard. Again, with 1.4 billion people, if we are not the fourth biggest or soon to be the third biggest economy in the world, again, then we're failing somewhere. So these are the minimum things that we should be touching. These are not great achievements that we are doing. This will happen. You give any other country 1.4 billion people, they will start growing at this level. And the other thing is that, and this, let me caveat all of this by saying that none of this is political commentary. My view on the economy runs across governments, whether it is the Modi government, whether it's the UPA. I'm looking at a much longer time period. I'm looking at it from, say, the start of the 2000s. And there I feel that's when government started failing us as its citizens. Not enough was invested in things like education and skilling. And that's also why I feel this lab is such a great idea, because it is doing exactly what should have been done way back then, where, because not enough was spent on education and skilling, people were graduating without knowing enough to be hired, immediately, or hired in relatively well-paying jobs. Companies still had to spend a lot of money in trying to train these people to make them job ready. And so now you've got people who've graduated and they are earning not that much, which means that their disposable income, I'm not talking about that 1% of our population that's earning well and they're seeing reasonable growth. I'm talking about most of the people. They're not seeing their incomes grow enough, which means that they're not spending enough on just things to buy, which means that companies have no incentive to invest more in India, because the capacity that they've already created is more than enough to cater to demand that currently exists. If you look at the RBI's data, capacity utilization of factories has been around 75% for the last, I think, now 12 quarters. So, that's a very long time where companies have not increased their capacity because they felt no need to. If 75% is being used and not 80, 85, 90%, why should they invest any more? So if private investment is not happening all that much, and even the government is saying that private investment is not happening all that much, then again, jobs are not going to be created, more new, fresh jobs are not going to be created that much. And so you go round and round. If new, fresh jobs aren't created, then again, incomes aren't going to grow. And so demand is not going to grow, and you'll just keep going round and round. So my very pessimistic view of the economy is that we're going to be at this 6 to 7% growth for quite a long time. The 8% plus growth that we need to really lift people out of poverty, to really accelerate India's development, the whole goals of Viksit Bharat 2047 and all of that. Even the government says that it will happen only if we grow at more than 8%. But that more than 8% is not going to happen unless overnight we start really spending on skilling and educating people so that they're job ready. And unfortunately, that's a subject for both the central government and state governments. And you need some sort of agreement there. And they're just too busy, doing politics over syllabus and whether to put Mughals in or take Aurangzeb out. And that's what they're concerned with, right? It's not about how do we train our youth in being productive citizens. So overall, short answer, yes, I think the markets are overshooting India's growth potential, at least right now.
Okay.
Yeah.
I just picked up on one of the very important thing, that it is the 1% who make a lot of money here, right? So rich are getting richer, poor is getting poor. Can that also explain the K-shaped recovery after COVID that perhaps World Bank also highlighted a year back that India is growing? Yes, it is the fastest growing economy, but it is coming at the cost of having a K-shape where there is this bigger people becoming bigger and the gap between the rich and the poor is increasing.
I mean, without a doubt, no. If you look at various different markets, say take automobiles. If you look at the data, most of the sales, about 85% to 90% of the sales that are happening in the SUV segment, and you know the MUV, SUV, and these are not cheap cars. These are pretty expensive cars. Whereas the low end segment, where back in the day, you know, you had the Maruti 800s. And the you know the Altos and you know those smaller cars, those just aren't selling because people in the market who would have bought those cars are not buying those because they're putting off their large purchases because they need their money free and you know they need their cash flow free right now. So they're not buying the small cars. The people who can afford the larger cars, those are the ones who are buying not 1, 2, 3, they're buying multiple. You know, you see already on the roads, you'll find if you look at registrations, families have 3 cars, you have 1 person in each car. It's, you know, that's what's happening. If you look at the real estate market, this again is something that I did some research into recently. In your metros, the top 8 real estate markets, the houses that are increasingly being sold and being constructed are the 3 BHK, 4 BHK, the larger houses. It's not the 1 BHK, 2 BHK houses. That demand is shifting to the tier 2, tier 3 cities. Whereas in the cities, in the large cities, the only people who are able to afford the houses are the rich. And you know, it's telling you what's happening with our economy, that exactly what you said, it's the K-shaped recovery. The rich are definitely getting richer. Whether the poor are getting poorer, I am not so sure, but they're definitely not getting richer fast enough. Inflation is going on eating. Basically, your nominal wage growth is not outpacing inflation. And so your real wages are either remaining flat or yes, maybe even reducing slightly.
Yeah, so inflation indeed is a big issue, especially in places like the metros. And I can substantiate it with something like the inclusion of people who are investing into the markets, the lesser savings from the higher ends, but more is, relatively, they are better placed in chota cities where a lot of untapped savings can be, through right kind of education, can be pulled up into the markets, because very less is being saved in bearing the cost of this metro cities.
In the cities, yeah, correct.
So that's where the next focus of perhaps SEBI is also transferring, where we can, bring out these tier 2 cities, including into the investment side, and whether it is into stock markets or otherwise.
It's also become so easy to invest now. No, you have all of these apps. You have Grow, and you have Upstocks, and you have Zerodha. All of these apps are making it so simple for anybody to just put their money in the markets, and it's location agnostic. It's not as if, it's not like back in the day where the only way you could put money in, you go to a broker physically to his office and then do it. And so of course then it becomes easier to invest in places like Bombay because there's a high concentration of brokers. But now with apps, you can be wherever you are. You can be, enjoying some vacation in Goa and sitting and tracking the markets and investing. You can be in your tier 2, tier 3 cities, paying much less rent. You're absolutely correct. And investing in the market. So that, I think SEBI has caught on to the next area of growth in terms of market participation.
Yeah.
Because in the last 5 years, at least the metros have been tapped out. Everybody who wants to invest in the market has already joined.
They're already into this.
Yeah,
right. So, yeah. So you have already answered to my next question that I wanted to really put across, but still I'll say, does the market reflect two Indias?
It does. So the market is a strange animal because a lot of what's happened in India post-pandemic is that people have discovered the market in terms of systematic savings. So the SIP as an instrument has really taken off post-pandemic, and that is what is lending the Indian market so much resilience. Because regardless of what happens in the world, there'll be some nuclear attack somewhere, God forbid, something really bad can happen. But your SIP is set up to be debiting your money every month. And so yes, there'll be some people who will stop their SIPs. Those are the ones who are on the brink, their incomes are on the brink. If they don't see their SIPs growing, they immediately put it elsewhere. But there's a much larger chunk of investors who are, kind of set it and forget it. They set up their SIPs and they're willing to see it play out over years. And so that regular monthly infusion of money into the stock market gives it so much resilience. It's that's what sets it apart, the Indian market also, because we've got so many investors, and many of them are doing SIPs, and so the market withstands a lot of the global storm that might happen, that can happen.
So can we say that internal domestic liquidity is making it resilient to take care of external volatilities and shocks?
Very much so.
Yeah.
Very much so. Yes.
Okay. All right. So coming to again, is India in an exuberance cycle?
Right. So and by India you mean the markets?
Markets, because that's where ultimately these guys are reading
Absolutely.
and understanding. Are we in an exuberance cycle?
We are also in a cycle of a lack of information. And again, this is why this lab is so important, because a lot of people are investing without understanding the fundamentals of the companies that they're investing in. Take the example of defense stocks. There are, just as the government started making announcements that we are going to be Atmanirbhar in defense, we're going to give orders to domestic companies, suddenly the defense stocks went off the charts. You had, companies like Cochin Shipyard and things like that, which would, in a year grew 400%. And what people don't understand is that it takes many years for a ship to be built, even something as simple as a ship to be built. So just because they've got their order this year, or just because the government has said it will place orders this year, is not enough to drive the fundamentals of the company. The revenue is not coming right now, the profits are not coming right now. So why are you suddenly investing in the company right now, where the actual profits and everything might happen 3 years later?
Maybe
and
they are timing it right.
And between now and then, a lot can happen that can delay the project.
Yeah.
So there's that. Then there is again the government going for, again the Atmanirbhar, that we want our public sector companies to do well. So public sector stocks started doing very, very well. Again, without understanding the fundamentals, a lot of our public sector companies aren't very well off in terms of their finances. A lot of them are very heavily in debt. Many of them are in losses. But just because the government gives an indication, a lot of people get swayed by that and invest in the markets. And this is sentiment driven investing. There's a lot of patriotism that backs it. People think that, government of course is going to back our public sector companies, it's not going to let them fail. So let us invest in these stocks. Sure, invest in them, but not at these exuberant prices. That might not be the best thing.
And ahead of the earnings.
Right.
Ahead of the earnings.
Correct. So that's basically what I would say, that the market is exuberant, but I think it's the nature of the market to be exuberant. It runs ahead, it runs on optimism, it runs on hopes and dreams, and so you can't particularly fault investors for hoping that they might make money, but you must educate them enough that they aren't gambling too much of their savings in trying to make money. And the same can be said also of derivatives.
True.
Yeah.
Very rightly said. IPO mania, back again. Oversubscriptions of 50x, 100x. Are these again the signs of confidence into new companies or the froth? That could be one question. Second could be retail investors who opened 35 million Demat accounts in last 24 months. Does this really signal inclusion of fresh investors or only inexperience?
Wow, these are great questions. So the froth versus whether there is some substance behind it, I think there's always some amount of substance to it. Because India is producing some very, very capable companies that are likely to see very strong growth in the future. But where the froth is coming in is because of some of the basic economic factors that I talked about, that most people right now are a little bit desperate in terms of trying to grow their incomes. Because once you factor in inflation, real income hasn't grown all that much over the last few years, whereas everything else has. Your rent has gone up, every other cost has gone up. Right now the GST rates have come down, so that's a little bit of a relief. But otherwise the cost of living is just gradually increasing, whereas your wages are not. So people are increasingly feeling this pressure, and that's one reason why they flock to IPOs in such a big way, because the hope is that you can make money quickly
On the day of listing.
Exactly. And that's also what is driving so much of this activity in the F&O segment, the futures and options. It's a lot of uneducated, inexperienced people who are just really, really hoping that they make money. And that comes to your second question about whether these number of Demat accounts that have been created, is it actual strength or whether it is inexperience. I feel it is both, because the number of Demat accounts definitely provides strength to the Indian stock market. The domestic resilience is something that the Indian market can boast that not a lot of global markets can boast about. The fact that we are so resilient to what's happening globally is definitely a strength for us, and that is because we have this growing domestic investor base. But the fact that they aren't that financially educated is definitely a problem. That's something that needs to be rectified.
That's a gap.
Yeah.
And there is a eagerness to get rich quickly, long awaited.
In every which way. I mean, you see the profusion of scams, people falling for so many stock market scams because somebody is promising them some exorbitant returns in such a short period of time. So the person who's being scammed, they don't have the knowledge to see that this is frankly impossible. And so they invest their money because they are desperate to make that money. So a combination of desperation and ignorance is very, very dangerous.
Yeah, very deadly.
Yeah.
Okay. That's a very right conversation as well as a piece of advice to every young student who's listening to it. Now I'll just shift the gear towards the global things, because you have also mentioned multiple times that India is relatively more resilient. So are we resilient in compared to rest of the world?
We are.
World markets?
I think we are. We are more resilient in terms, at least of the major stock markets in the world. I think we are more resilient than them, simply because a lot of the flows, basically the balance of flows between FIIs and DIIs in India, it's the influence of the domestic investor base has grown very sharply over the last few years, where I think in the bull run of 2003-2008, where the foreign investor accounted for something like 70% of the market, now it's much closer to 50%, which means 50% is coming from the domestic market. And so there's that, And a lot of the domestic market is coming in the form of SIPs, which again are a very, very predictable and timely sort of market infusion, or cash infusion into the market. It does provide a lot of resilience, and that's the strength of India's market right now.
Okay, okay. Quick comparative hit on the global perspective. Has India become the new China for global investors? What's your take on that?
No.
No. Okay.
No. I mean, this comparing India to China in any way except population size, to me it's a very silly comparison to make. Their economy is just way larger than ours. We are about 4 trillion right now. They're about 19 trillion right now. So there's anything that they can do at a scale that so hugely exceeds anything that we can do, that anybody who's trying to convince you that we are doing better than China or that we can compare with China in any which way is spinning some sort of tales. And I'm not saying this in putting India down. We are doing decently well. It's not as if we're doing very badly. Yes, I'm pessimistic about our prospects in terms of the superlative growth that governments would try to make you believe, but we're doing decently well. It's not a put down when I say that we shouldn't compare ourselves to China. It's just that China and the US are so far ahead that it serves no purpose to compare ourselves to China.
All right, all
Yeah.
right. Point well taken and understood. Now the most recent hangover, how important or how much can we draw from this US trade deal? This is really, put water on all the optimism in last few days. Until few days we were just touching closer to the all-time highs, and since then we are seeing this. And how much is the reality, and which side do you think it will take, and which could be the possible sectors for the say few months ahead of this deal coming to us?
That is, you're asking if a deal comes through,
yeah.
which sectors would benefit?
Yeah.
That's
a current hangover which is like
correct.
Pressing.
So, I mean, just to see which sectors would benefit, just look at which sectors are hurting right now with these 50% tariffs. Because the first tranche of the deal, and this is something now that me as a reporter covering the Commerce Ministry, this is what I've heard from the government, that the first tranche of the deal, which is likely to happen, they say soon, but who knows when this soon is. But even if it happens in the next few months, the first tranche is going to deal with the tariff issue. The larger issues of market access and whether they can export agri commodities to India or not, or whether India can export our shrimp to the US, all of those more complicated issues will be later.
Secondary.
First, they want to address the tariff issue. So if they address the tariff issue, then that means this 50% tariff is suddenly going to come down, which then means that the sectors that are currently being hit and which are hurting because of the 50% tariffs, those you can expect those stocks to suddenly rise. So you're talking textiles, engineering products.
Note of it. That's where our next conversation would perhaps go.
No, absolutely. So definitely textiles, definitely engineering goods. These are steel and aluminium. Steel and aluminium are unfortunately sectors that are being hit by 50% tariffs outside of these, these tariffs that are linked to Russian oil imports. The US government had imposed these 50% tariffs independent of everything else. And it's not just India, it's globally. US imports of steel and aluminium face 50% tariffs. So suddenly, if India manages to sign a trade deal where steel and aluminium that we export to the US has lower tariffs, that puts us at a huge advantage compared to the rest of the world. Because steel and aluminium are core metals. They are used for nearly everything.
Now, again, on this future of India going forward from here, as per S&P's reports, consumption rather than investments are going to drive India's growth in 26 and 27. So what would be the strengths or vulnerabilities around a consumption-led growth model? How do you see it?
Okay. Let's talk about the strengths first. The strengths of a consumption-led model in a country like India is obviously the fact that we have a lot of people who consume. Our population is so large that if you're going to base your growth on consumption, then it's a fairly safe bet that people are at different levels going to consume. Your rich are going to consume the luxury products, but your less than rich people, at least your base essentials, salt, oil, chicken, where the rich might eat mutton, the poorer people will be eating their chicken. They won't give that up very easily. If they do, then there's paneer. So just by sheer dint of the number of consumers, you're going to get some amount of growth from consumption. So that's the benefit. A consumption-led growth is it's a resilient bet. But the flip side of it is that it is still a bet in India, because so divided in two ways. There's rural consumption and there's urban consumption. Rural consumption, unfortunately, because such a large part of our population is still dependent on agriculture for their incomes, is very dependent on the monsoon. This year we had a pretty decent monsoon, and so agriculture has done very well. Next year, if El Nino again starts playing a factor and the monsoon is not good, you'll see rural demand again dip. And it's going to be like this as long as our rural population is linked to agriculture. It's going to be linked to the monsoon in a very big way. And so you can't peg your hopes of economic growth to something as that varies so much as the weather patterns or climate patterns. And with global warming happening now, climate change happening, your monsoons are also changing patterns. They're starting to come a little later. So the agriculture sector, the farmers are having to change their crop patterns, when they sow, when they reap. All of that is also changing. So that's rural demand. Urban demand is more steady, but if you want any sort of radical growth from there, incomes are going to have to grow. There's only so much that you can do with cutting income tax rates and cutting GST rates, which, to this government's credit, they did both of those things this year.
Yeah.
This last budget 2025, saw income tax rates come down, the slabs being eased. And
prior to this Diwali also, they made this very attractive things for people, affordability to be increased. So maybe they are playing on this consumption result.
They're hoping, but you tell me, how many people, your income remaining the same, how many people are going to take the savings because they're paying less tax? Are they going to take that money and spend it? Or are they going to put it towards paying off their debt? Or are they going to use it to invest, in some sort of savings instrument? The government is hoping that they will spend on consumption, but that's not how human behavior works. When your income is tight, you don't use the extra money to go out and spend more. You use it to shore up your savings or to reduce your debt. It's only when you're sure that your income is growing at a comfortable pace is when you go out and spend more money. And that, unfortunately, that income growth is happening only for this small segment of the population. It's not happening for enough people to drive our economic growth forward. So yes, between consumption and other factors, consumption is a safe bet to drive economic growth. But even for that to happen, we need a few more things to happen, a few more structural changes.
So there cannot be a direct relationship between delta Y and delta C. So propensity to consume is not related to what this increase in income would otherwise entail if there is a tax cut. So it might not directly result into that.
Because a tax cut is not an increase in income. It's only an increase, it's a small increase in your disposable
income. You relatively feel that your income is increased. But so propensity to consume is not too high.
It won't.
It won't be.
There'd be a small dip, a small blip as we saw in this Diwali period. Car sales was suddenly, but again, it's very important for people to be careful when they read data, because yes, after the GST rate cuts, car sales reached some sort of record high. But that's also because a lot of people, as soon as it was announced, 15th August was when the PM said that it's going to be our Diwali gift. Since then, people stopped buying. They stopped buying cars, they stopped purchasing large things in the hopes that the GST rate would come down. So all you saw was demand shifting in time. It was not an increase in demand. It was just people who would have bought earlier were buying later. So, and some amount of people who bought because it was cheaper, but that entire jump was not because people were buying because it was cheaper. It was because demand was shifting forward in time. So data also can kind of try to fool you in some ways, and there are a lot of vested interests, especially online. If you guys are on Twitter, X that is, there are a lot of vested interests who try to portray a certain picture of the economy. Some of them will try to show that nothing good is ever happening in India, and another side will tell you that nothing bad ever happens in India, that everything is only a master stroke.
Yeah.
The truth is somewhere in the middle, and that's why you need to look at the people, read the people who you see who criticize as well as praise. I would like to believe I'm one of those, that my commentary on the economy is more balanced, but I will leave all of you to judge that. I mean, I can say something and then why should you believe it? So read with a view to see, what are the person's biases behind the information that they're putting out. I think that's very, very important, especially for people who are going to be investing in the market, who are going to be trying to figure out how the real world impacts the market. It's very important for then for all of you to have an accurate view of the real world and not a biased one, whether it's a negative bias or a positive bias. Read both, come to your own conclusions.
Great, that's wonderful. Be watchful on 28th of November when these numbers will really come and speak whether that was a master stroke or not. Did it result into consumption? So 28th of November we are all watching. Now I would now quickly move towards something which is immediately we are heading towards the budgets. So last week which caught my attention was this fourth time in a row meeting of BSE AMFI by the capital market players to talk to Sitaraman on the push for lower security transaction tax on cash market compared to derivatives. Now that's where we are really hooked on. This time not the capital gains, but it is the security transaction tax that is catching everyone's attention. So why is it that these BSE and AMFI are after the cash markets, that not into derivatives? That's why would that ask be, and what could be the implications of such a demand?
Okay, so there are two things. So one is why cash market and not derivatives. That is, they are taking the cue from the regulator. SEBI has made it very clear that it is not that gung-ho about the futures and options market, because it's seen a lot of developments over the last few years that are very concerning. It's seen a lot of people getting into it, and it's done these studies where it's found that 93% of them are losing money. There are stories of people borrowing money to invest and then losing that amount and going further into debt and things like that. And the reason for this is very simple. It's the fact that these are, again, uneducated, untrained people who are going up against really sophisticated algorithmic traders. And you can beat the computer maybe once, or twice, but 98 or 99 times the computer is going to beat you. And that's again not something that you should feel bad about. It's just the reality. A computer is a computer. It's very, very hard to beat. It's being able to process data not only at a scale that is much higher than what you can do, but much faster. So trying to beat it is a fool's game. So that's one reason why SEBI has been saying don't, it increased the lot sizes, basically making it a little more expensive for you. If you want to enter the market, you have to buy a much bigger lot. So lower income people were immediately weeded out. It reduced the number of expiries so that there are fewer available options for you to gamble your money. All of these things. So I think the market participants, they took their cue from SEBI's directions, and so they're saying that okay, let's not try to make it cheaper to enter the derivatives market. Let's focus instead on cash. And that comes down to the previous thing that we talked about, which is that the tier 2, tier 3 markets, those are seeing now significant growth. But those are also the areas where incomes are somewhat lower than in the metros. And so if you can reduce the tax for them to enter the market, then you might encourage their participation.
Serious participation.
Right. And that is something that India needs. Again, we need more people to be more financially literate and more active in every sort of, aspect of the financial market, whether it is the stock market or whether it is to do with banking, insurance. We need people to be more active participants. So if there's any step that can make it cheaper for them without impacting government revenues in a very big way, I think they should go ahead with it.
Stop the speculators from speculating, make something else more attractive.
Correct.
Okay, fine. So great. Now I just had gone through some of your articles on the LinkedIn. So, so from those, because we would like to be more enlightened on those aspects that you have really posted. So one of the articles that caught my attention and could be of relevance to every young student here, applying artificial intelligence in the post-COVID world, you had written quite some time back. In going through that, there is some specific question that brings to my curiosity is, AI is expected to add 15 trillion in global GDP by 2030. I'm just reading it out from there. If such transformative technologies reshape productivity and corporate profitability, do Indian stock markets already price in the AI-led future, or are they ignoring the risk of uneven adoption?
So those are two different things. I don't think the markets are yet pricing in just how transformative AI can be, because even the people who are adopting AI right now are doing it in a kind of haphazard ki, chalo, let's put AI into this, let's see if it helps.
Force fit.
Kind of thing. Yeah, it's because it's a very powerful tool. And so you want to use the tool and see whether it works or not. And so it will take a few more years for a lot of these companies to actually deploy AI in an effective way that affects their profits. Take for example, I mean, have you noticed how hard it has become to talk to a customer service person anywhere, in any company? Anytime you try to contact them, you get pushed towards an AI chatbot. And it's just trying to answer your question. Most often it fails. My prediction is that in most sectors, these AI chatbots, they're going to stop using them at some point because they aren't as effective. They're being able to weed out some of your more basic questions, like on Zomato, you have the, where is my order? So then it will tell you your order is on the way. It's like, bhai, even I can tell you the order is on the way, but like, why is it delayed? What is happening? Can I speak to the delivery partner? Can I speak to the restaurant? Can I speak to some human? That is what drives customer engagement. So as soon as they figure that out and some other platform figures that, okay, let's remove the AI chatbot, let's in fact have some people there answering questions, you'll see customers starting to move towards those platforms more and more, because frankly, it's very frustrating talking to a computer. These AI chatbots, they might become more sophisticated with time, who knows. So like that, that's just a small example of AI being deployed in a way that companies hope will help, but maybe they'll find in a few years that it's not actually helping, let's pull back. So I don't think the market yet is pricing in these developments, but let's see. AI, it's a very powerful tool, but again, as you said, the benefits are going to be very localized. Not every sector, everywhere, every company is going to benefit from AI. One, it's hugely capital intensive, so most likely it's going to be the big companies that benefit from it. You're not going to see your MSMEs suddenly using AI in any big way. Two, there are particular sectors, right? Because so India, again, we're a labor surplus economy. We have so many labor surplus sectors like leather, textiles, the overall apparel, clothing, all of that. What are they going to do with AI? What is AI going to do for them, except on the margins where some big company can use it to analyze market trends? Where is demand going to come from? What kind of clothes are people wearing? Those the big companies can do, but the smaller textile firms, they have nothing to do with AI. They aren't going to benefit from it. So yes, AI adoption is going to be uneven, and I think it's still very nascent in India, at least. We don't quite know how we're going to use it in the next few years.
Okay. That's your take on AI. So we are not pricing in AI-led growth right as of now.
But I should also warn you that this paper that I wrote, it came out before these large language models became a thing. It came out before ChatGPT was a thing. I was talking about AI before these things happened. So these large language models have come and they've disrupted the situation quite a bit. But basically all that I said, I still hold by it. Yeah.
All right. I think the conversation can go on, and we can hear you on and off. So just concluding it with a kind of a rapid fire kind of thing.
All right.
So that's okay. Then should I shoot it?
Sure.
Okay. So some questions on the market sentiment. Your view on Indian markets, bull or bear for 2026?
Bull.
Bull. Best word to describe Indian retail investors?
Consistent.
Consistent. Overvalued sector today as per you?
Defense stocks.
Defense. And the underrated sector?
Anything to do with old age. Any company that caters to, that provides services for senior citizens,
okay.
They're the next growth area.
All right. One global event that could shake Indian markets overnight?
Oh, wow. Well, we already saw it in terms of a pandemic, but say something absolutely unexpected happens and India or the US suddenly makes it visa free for Indians to come. Our markets will crash overnight because the amount of wealth and talent that is suddenly going to flow out. So things like that. So things like a trade deal, if it involves some human element to it in terms of the movement, because India is very interested in in any trade deal that we do, we have been trying to negotiate how can we get more people to be eligible for emigration to go and work in your various countries. So if there is some sort of easing there, that in a big way, then I think that could affect our markets. Yeah.
More to go on the rapid fire. India specific. Is SIP the new FD?
Yes.
More powerful today, FPIs or DIIs? I think you have answered it.
DIIs.
DIIs. One reform that can make markets more truthful.
Increasing the minimum shareholding norms. Basically, right now, or rather decreasing it, sorry, the promoters should allow a larger share to be held by retail investors. Right now, the limit is 25%. You make it 30%, 35%. I mean, yes, your ownership of your company comes down, but then the markets become slightly more transparent, more fair. Right now, out of the 12 public sector banks, 6 of them don't meet this minimum shareholding norm thing. It opens up a lot of scope for the manipulation of stock price if retail participation is very little in a stock.
Okay.
Yeah.
Oh, that's interesting. Okay. One bubble no one is talking about. Can you think of something?
A bubble. No, I think people are talking about these bubbles. I mean, the AI, whether AI is a bubble or whether what's happening in real estate is a bubble. I think people are pretty, they've caught on to the bubbles that are happening. I can't think of any that they haven't.
They have identified all the bubbles.
So
playing
far.
around all the bubbles.
I think so.
So personality based question, if Nifty were a person, who would it be? Optimist, realist or a dreamer?
Oh, it's an optimistic dreamer. You know, it's somewhere there.
Okay.
Yeah.
One financial habit India must learn from US?
Oh, how to use credit more effectively.
Okay.
And this is not, again, this is where financial education comes in, because in the US they use credit very, in an effective way. They don't just borrow and then be like, we won't repay. They borrow with an intent to repay, but that borrowing fuels a lot of their consumption and their lifestyle. India is still not there yet. We either look at borrowing in a way that, baad mein dekhi jayegi, we'll pay back the loan, or you tend to over borrow and then you find yourself in a debt trap. But borrowing sensibly is something that we can definitely learn from the US.
So last of this, one thing India does better than any market in the world.
Oh, withstand global crises.
Okay. So we started from resilient, we are ending with India being resilient.
Correct.
With respect to rest of the world.
And as I said, the Indian investor is consistent. My commentary on them is also consistent.
That's wonderful. So we have touched upon several aspects as much as we could take the best from Sharad here.